Hi guys, how's it going? It's Aldatom Chagi and welcome back to my YouTube channel. In today's video, we are going to talk about consumer stocks or supermarket stocks. These stocks represent companies that produce goods or products that we want and use regularly. These are considered defensive stocks because no matter the economic state that we are in, we are going to need these goods and we're going to buy them regardless. They are essential products that people are unable and unwilling to cut off their budgets, regardless of their financial situation. So whether the inflation is high or low, those goods will always be in demand, so people will always buy those goods. That is why they are considered defensive stocks, simply because the products that they are selling are always going to be in demand. So these are goods like food, water, and personal items. They are necessary for living. Stocks can be a good option in times of recession because they provide consistent growth, solid dividends, and they have low volatility. And because we know that the products are always going to be in demand, the company is expected to always generate revenue. So it's highly unlikely that you find this kind of companies being in this kind of business struggle to the point that they actually be out of business. It's highly unlikely. And because of high demand, we will take whatever price that these businesses throw at us, simply because we need this kind of goods for our daily living. We need to eat, we need to bath. So whether they say inflation is at 15% or whatever, I'm exaggerating, but we are always going to buy these goods. If now ShopRite decides to sell toothpaste at the trends, we are going to buy because we need to be clean, So this kind of stocks are always going to be there actually for very long time, simply because the products that they are selling are always in demand. So to have a supermarket company in your stock portfolio wouldn't be a bad idea, because we know that these companies are going to be around for the longest time, if not forever. This would be the likes of ShopRite, Spar, and Pick n Pay. So if you buy ShopRite shares, or already you have ShopRite in your stock portfolio, you can hold it for like 10 to 20 years, because you know that this business will always be around, so you won't get that scare of whether they're going to run out of business, or this products that they are producing will be in demand. If people will stop buying and they will stop generating revenue, you will hardly have that scare because of the business that they are in, that they are selling these goods that we need for our daily living. And if you can check this kind of companies, they've been around for the longest time, right? So I just checked ShopRite on Yahoo Finance and Pick n Pay as well. They've been around for more than 20 years. So it is one of those stocks that you can buy and hold for the longest time. But then this does not suggest that it cannot be a bad stock. Remember, there's a company and there's a stock, and a company is not necessarily a stock. A company can be in a good business but be a bad stock, and we see that happening with Pick n Pay right now. Obviously, Pick n Pay it's in a great business, right? And their products are always in demand, as we have already established, but they are not the hottest stock at this moment. And on the other hand, when we look at ShopRite is doing well, right? The stock is very attractive. People are jumping on ShopRite, and people are selling Pick n Pay if they have not already. So hence I'm saying that we have a company and then we have a stock. And the company can be a good company but not be a good stock, simply because what consumers want is not necessarily what investors want. Consumers are looking for convenience, low prices, and investors are looking at things like your profitability, mode, earnings, dividends, all of those things. But then there's always a link, because if a business is doing well, then they're going to be profitable, and then they're going to report an increase in earnings, and that is going to attract investors. And when a stock is in demand because of the attraction, then the share price is going to increase, and then over time we get to see the company growing. The reason why you should invest in consumer stocks is because they provide essential products that people need regardless of economic conditions, and these companies are less likely to be affected by economic downturns as compared to other companies that are not providing essential products. And because of that, they provide more stable and reliable earnings. So to have such stocks in your portfolio provides great stability during market volatility. And another reason is that they provide consistent dividend income. For example, Shoprite has been paying dividends for 31 years consecutively, even though it has a low yield. But if you have it in your share portfolio, you know that it's going to pay you dividends consistently. So it's going to provide you with consistent returns. So these stocks are actually an option if you are looking for companies with long-term growth potential and stability. So with supermarket stocks, moat is a thing. This is the ability for a company to maintain competitive advantage, and that should help the company fend off competition from its own competitors and maintain profitability into the future. And moat is a thing because consumers have a lot of options. We have a lot of options. So if today you feel like you don't want to buy from Shoprite anymore because of whatever reason, you can just go to Pick n Pay or go to Spar. So moat is actually a thing, and if a company is not trying to be better than its competitors, try to take competitive advantage serious, then that is going to badly affect their business. So that's why competition is way too tight in this industry. They need to keep their costs down, they need to be innovative, and they need to always improve their processes. And if they are now going to keep their costs down, their operating costs down, that shouldn't be in a way that is going to affect the operations of the business. Imagine if now they say they're going to cut down electricity cost simply because they're trying to be profitable. So it has to make sense. Them keeping costs down has to make way much more sense. They need to cut those irrelevant costs and they need to be profitable. So they also need to sell at fair selling prices, because if now their prices are way too high, we are going to go to the other supermarkets. And they need to also invest in their brand, because consumer behavior is everything in this kind of industry. So the stores need to be appealing to consumers, otherwise they are going to have their sales affected, simply because consumers will now go to other supermarkets to do shopping. Imagine if now I'm gonna walk in Checkers and the store is just too dirty, too filthy, they're not cleaning, things are not packed nicely. I'm not gonna get the best shopping experience, right? So I'm going to go to another supermarket. So the brand is very much important for them to create and build that customer loyalty in customer base. And to talk about innovation and processes, Checkers has 60/60, Pick n Pay has launched their ASAP delivery thingy. I don't know what they call it, but I think it's ASAP, something ASAP. Pick n Pay ASAP, yes. So you can see that they're really trying to give customers the convenience and that great experience of shopping with them. That also sets the business apart from other competitors. Imagine if now Checkers had that and Pick n Pay doesn't. Would you now just decide to just wake up and go to Pick n Pay to the store if you can just get your groceries online? So they need to always be on top of their game, and they need to give consumers that great shopping experience and give them convenience, and they need to be on top of consumer trends. Another thing to consider is the financial performance and dividends. Remember, these are considered defensive stocks, so they need to provide consistent earnings and returns, because we expect them to always be profitable, simply because they are always going to generate revenue, because the products that they're selling are always going to be in demand. That is why. And in terms of high inflation, as much as we as consumers are going to be badly affected by it, we expect these companies to be profitable, because we are going to buy their products regardless. So at times like this, they are highly profitable. You find that the companies reporting a growth of 10% plus in their earnings, simply because they are selling to us at a very high price and we are going to buy regardless. So at times like this kind of companies are very much attractive to investors. Supermarket stocks are important for portfolio diversification. It can help balance out the portfolio. Remember, in times of recessions, they are most likely to do well and not be affected by economic downturns. And remember that investing is a long-term thing, so to have these companies in your portfolio might be a good idea, because you know that you're going to hold them for a very long time. So comment down below with the stock that you have, a consumer stock that you have in your portfolio, and why you bought it and why you didn't buy the other ones. And with that being said, it's the end of the video. I hope this was very much insightful. Don't forget to like, comment, and subscribe. I will see you in my next one. Bye.